Hello team, how are we doing? Today I'm going to try and make this as short and snappy as possible, not a 50-minute, but I want to talk about the chatter that's been going on with company insolvencies. And is this going to tip us, number one, into recession, but also start fulfilling the prophecy, or could it become the self-fulfilling prophecy of the property market, UK property market, going into meltdown in 2024? So today I want to lift off the lid of the figures, the stats, crunch a completely data set to the one we've actually done before on this channel. And I want to objectively throw it out for conversation about what do these stats actually mean and what's the direction we're heading in. So that is the agenda for today's live stream. So a very warm welcome to everybody who is new to the channel. In this channel, we aim to get below the mainstream and the social media headlines, work out what's actually going on based on objective data. And as we are live right now, if you can hear and see me, please give me a thumbs up. Please find something in the chat box, which I've just realized I haven't turned on, to make sure you can actually hear or see me. And as we go through, even if you're watching on the replay, please make sure you put your comments in, put your thoughts in so we can interact and have a chat about everything. Cool. Let's crack on straight with it today then, team. I want to do a little bit of a recap because I've not done the sort of overview, big picture, how the property market works, how it's combined with or is symbiotic with the economy for quite a long time. And I used to flag this up, courtesy of Economics Help, how the UK economy and the UK property market are symbiotically linked, right? And it's very cyclical. So we can find ourselves going into a descending spiral, of course, an ascending curve, if you like, of confidence, depending on which way things are going. But let's just see how this works. Let's assume that everything is kicked off with a fall in house prices. House prices coming down, people have a perceived fall in wealth and confidence and therefore spend less. They spend less money goes into the economy struggles. The economy struggles. Potentially, when the economy starts struggling, people get made unemployed because businesses go under or businesses have to contract, people become unemployed. That's going to increase or decrease affordability. It goes into house prices and we go around the cycle. And of course, this can start with anywhere. This could start with businesses going out of business. Therefore, unemployment goes up. Therefore, people have less confidence. Therefore, if you can't buy property for what you wanted or you can't borrow what you wanted, the property price is going to go down. The circle continues. So we can see there's this link. So when we are talking about business insolvencies, there is a direct link between business insolvencies and the UK property market. But the headlines are talking about highest level of business insolvencies on record. And of course, the chatter, therefore, is here we are, we're at the tipping point, we're about to go into serious deep recession, economy's tanking, property market's going to follow suit. Is that true, right? Or are there other hypotheses out there that we could talk about? First of all, before we talk about that, let's talk about the three crisis triggers. So we're still in recap mode right now. Crisis triggers for the property market are number one, affordability, number two, negative equity, and number three, unemployment. We know there's been the unaffordability issues or the affordability issues over the last 2 years with the cost of living crisis. I have made some videos over the last couple of weeks that have talked about people's affordability improving. And I want to just sort of caveat what I mean by that. Because I know a lot of people go, oh, affordability is not improving. What I'm talking about is that the level of unaffordability is getting worse at a lower rate, if you see what I mean. So we are on the trends are going towards an improving picture for people. Utilities are down, mortgage rates coming down. I did notice this week that some banks have put their mortgages up for the first time since last summer. So that's an interesting little indication. I don't want to talk about that today, mortgages going up, but mortgages could not carry on going down forever, right? And some banks are lowering mortgages for, loss leaders to bring businesses in, but the base rate has not changed, right? So swap rates ticked up in January as well. Anyway, affordability, so I'm talking about the level of unaffordability easing a little bit with the trends. Now, if we look at the second one of these crisis triggers, negative equity, we're actually not seeing huge levels of negative equity right now, depending on what models you look at. So if we're looking at sold prices, we haven't seen those huge, 10, 15, 20%, even 30% drops that people were talking about a year ago. We have seen that in real terms, but real terms doesn't affect your equity in a property because, of course, equity is linked to nominal values and your mortgage is linked to nominal values. Now, there is definitely an argument out there, right, that there's a lot of properties on the market that are not selling, and when they are selling, they're selling well below, the market value. But until you really know what that property is worth, and it's difficult at the moment because of the, lack of transactional volume, it's difficult to assess whether a lot of people are in negative equity. It's not a case that we are seeing the property market decline substantially in nominal terms, and therefore people have that very real understanding they are underwater. And we are also still not seeing forced selling. So negative equity is still not a massive issue. And then the final piece of the puzzle is unemployment. Clearly, unemployment goes up. People cannot afford mortgages. Doesn't matter the affordability anymore. If you're unemployed and your income goes to zero, your affordability really ramps up at that point. Okay, and that's when things really start to bite. So we've always said, or I've always said, that the key to this UK property market is what happens to the economy. What happens to the economy will lead to unemployment either going up, staying level, or going down. Okay, so that's an overview of where we are. But so AJ saying, haven't got negative equity or unemployed. Correct. And the question is it coming or not? So what I want to talk about today is how do these figures of UK business insolvencies link to that unemployment figure? Okay, how's it going to feed into the unemployment figure? And how's that therefore going to affect the property market? Because this is why we're here, ultimately, is to understand and talk about property. So I'm going to go into the data. I'm going to show you where we are with the statistics overall. And I'm also going to run through some considerations that have been running through my mind that might be contrarian to some of the other narratives that are out there right now. Before we do that, I'm going to hand over to my past self for 30 seconds to talk about how you can help me support the channel. Regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Cool, so please do subscribe now if you haven't subscribed. If you're a multiple viewer, please hit subscribe. If you are new to the channel, you want to see more stats. If you like that sort of thing, let's subscribe. So let's look at the report. So here are the actual figures, okay? Here are the graphs. And you know that I always like to talk about trends, not absolute figures. So when we look at this graph with insolvencies, the total company insolvencies is this black line. So we can now see total company insolvencies are above the peak from the 2008 financial crisis. It's actually ramped up a fair amount, right? I'm going to talk about this dip, which, funny old thing, comes over COVID. And this is going to be one of the points I want to bring out of this. We can see that creditors of voluntary liquidations, these are called CVLs. Now, if you're not fully into how insolvency works, you've basically got two types of insolvency. You've got a voluntary liquidation, which is where, as director of the company, you go, look, we are insolvent. We're going to voluntarily put ourselves into liquidation. We're going to go and speak to the creditors about it and try and come up with an agreement with the creditors, versus compulsory liquidations, which are when your creditors will effectively force you into liquidation. So when we look at these, we can see CVLs have spiked up a lot, way above 2008, but they're actually, the compulsory liquidations are, I would say, quite significantly down from 2008. So even though that total picture of insolvencies has gone up, it's a lot more of the voluntary liquidations that are happening rather than big nasty creditors forcing you into liquidation. So 2008, there's obviously a much higher amount of forced liquidations by banks. Creditors are going, right, we're going to shut you down because you owe us money. So this shows for a start that it's less of a I don't know what the right word is, hostile environment. The liquidations that are happening are voluntary. It doesn't mean that they can't trade. Okay, you're going to be in liquidation if you're insolvent. Insolvent means you can't pay your bills, right? You're more going out than coming in. But that's the first thing I wanted to note. Let's scroll down. I'm not particularly interested in going through the graphs that go over the same thing several times, which these graphs generally do. The next thing I want to draw our eyes to, sorry about the scrolling, it's slightly frustrating, it's all the way down. Same thing again. Oh no, so this is the next one, right? So this is now looking at the graph in a different way. So this is the liquidation rate as a percentage of overall companies in the UK. So when we look at this, there is a different picture that's painted. So when you look at the liquidations per 10,000 active companies, okay, this graph, I've not actually seen it all the way back to 2008. This only goes back to 2014. Interesting selective piece, bearing in mind the previous graphs were pre-2008. This is 2013, and we are lower as a percentage than we were in 2013. Now, I'm not too fussed about 2013 because there's going to be lag in the system. Trend-wise, we can see we've had a big jump up, and we've had a little top tick up in trend, which shows in the last quarter the trend has increased. So it's flattening off, and it's now increased a little bit. By the way, I don't think any of this is unusual, bearing in mind we're in a quantitative tightening cycle, which means that interest rates have gone up from 0.1 to 5.25%. Any company with variable rate debt in there is going to be struggling. This is the whole point, right? This is the whole point of tightening. This is the whole point of trying to fight inflation. It's trying to, take money out of the economy. It's not trying, it is taking money out of the economy. And it's putting pressure on businesses. Now, the argument goes that I don't particularly want to get in today, that it's the wrong tool for the job. We're putting all this stress on the economy when we shouldn't be, because it's transitory inflation. I don't want to go down that rabbit hole today. I purely want to look at these figures. So I think this is more telling as a ratio. The next thing I want to look at is what are the industries that are being most affected. And you can see very clearly we have three industries that are being affected the most out of this. We've got construction, we've got wholesale and retail trade, and we've got accommodation and food service. Now, I have to be honest, I'm not a massive expert on wholesale and retail trade, but I know a lot about construction, having a construction company and being in property. And as somebody who likes to go out to eat, then I think accommodation and food service is an interesting one. So the biggest one by country mile is construction, by the way, in terms of where we're seeing the insolvencies come in. So this is what I now want to dive into in terms of those sectors. And I want to ask some questions and challenge this data, right? So if we go back over to the iPad, this is what I want to discuss. The first thing I want to discuss is COVID loans. Okay, so bounce back loans and CBILS loans. For those of you who don't know, for whatever reason you don't know a lot about companies, obviously over COVID, a lot of companies were offered an awful lot of basically free money with very little in the way of checks and measures. Now, from my point of view, this is clearly going to skew figures. This is clearly going to skew our economy, because I would imagine you've got a lot of businesses that are struggling anyway, okay? And regardless of whether COVID hit or not, you've probably got a lot that are teetering on the edge. Businesses that are teetering on the edge are basically given a lifeline of free money to suck on and get them through for another 1, 2, 3 years, or just take money while directors are there have certainly been fraud involved, or directors getting money into a business and probably paying back the directors' loan accounts. But what it's done is, I feel, it's given a lot of companies that probably should have already gone under a lifeline to drag out their, slow, painful death for another 2, 3 years. And if we go back to these graphs, right, and let's go back to here, we've seen a massive dip down, okay, over COVID, unsurprisingly, because business has got free money, and there's probably going to be, it's not going to be the time for all of those insolvencies. And then it spiked back up. So just like the housing market, supply demand, I'd imagine there's effectively, and I don't know this, by the way, so I am just putting this out for discussion here. So I'd love to get everybody's point of view on this. I would imagine drop off in insolvencies. And then as we go back to trading, of course, it's going to be a lag period, but a lot of companies that would have gone over 2020, 2021, 2022, and are going now, they're going into insolvency now because they've had that lifeline of cheap debt, which they may well be running out of. So that's the first consideration. Has that caused a skew up because of the lag effect of people getting through it in the first place? So that's the first question I've got to ask on all this, COVID loans. It's gone full screen. Look at that. I didn't mean to go. So how many companies would have gone under if CBILS bounce back loan hadn't come out, and therefore is that data skewed? The next question I've got to challenge this data is, what is the mix of business size in this insolvency set? I've been doing loads of research today. I've been looking hard to try and find any sort of indication if we can break this down by size of business. And when I say size of business, it could be turnover, but also number of employees, right? So this data set comes with this effectively methodology and quality document. And it talks about where the data sources come from. It talks about everything, calculation rates, and of course it's seasonally adjusted again. Nothing anywhere talks about the mix of the size of businesses. And I feel this is important to understand. By the way, when we don't know something, it could be either way. It could be it's really big businesses going under, right, and making loads of people unemployed. Or the other way, it could be it's very small businesses going under and therefore not adding to the unemployment pool. And one of the reasons, right, I just want to, just for absolute crystal clarity, to be crystal clear on this, the point I'm doing this video is to challenge this data set, not saying that the data set is wrong, saying that companies are not going out of business. I'm trying to establish the objective and the actual numerical link between this and how it's linking into that unemployment rate, which is the third criteria in our property crash sort of trio, right? So important to understand that. So I've done a lot of research here, can't find anything. When we look at UK businesses, right, I've taken these from the UK Businesses Stats and Facts for 2023, which we've just come out of. When we look at business size, the majority of businesses in the UK, and by the way, there's 5.5 million businesses in the UK, 5.555 million. 5.547 million are SMEs, which are classed as 0 to 249 employees. So pretty much the entire section of UK businesses are under 250 employees, right? If we go down and have a look, and I'm just going to try and zoom in on this to make it more obvious, right? In 2023, there were 5.51 million small businesses in the UK with less than 50 employees, which was 99.2% of the business population. So almost, when you look at that, I would suggest that is a statistically significant figure, that almost all businesses in the UK have less than 50 employees when you look at it like that. Okay, very few. So it's 0.8% have more than 50 employees. So when we're looking at these figures, this is what I want to know. Out of these, how many of these companies are 0 to 10 employees? Or it could be 0 because if it's just a director, it could be 0, right? How many of them are 0 to 10 employees? How many are 10 to 49? How many are 49 to 250 and above? Because I think that's giving us a much better picture of what's actually happening in terms of what sort of size of business are going under. Okay? Because could it be, for example, that it's a load of basically single director, no employee limited companies, which there are a lot of them out there, by the way, right, who have taken a load of debt. Maybe they've taken bounce back loans to keep them going. Maybe they've taken bounce back loans out, whatever. And they're now winding up the businesses. And the fact that a lot of this is creditors' voluntary liquidation, it could be that the only creditor is HMRC, bounce back loan, CBILS. I don't know. I'm completely hypothesizing, putting a narrative out there that could be completely wrong. We could look at this, and these could all be major businesses, right? Each time putting 10, 20, 30,000 people onto the street. The answer is I just don't know. Looking at this, I tried to find some stats about how many businesses took bounce back loans and how many of them have gone wrong. So here's some facts. 1.56 million businesses took, and this is an article about bounce back loans. 1.56 million businesses took bounce back loans during COVID. So 47 billion was provided by the bounce back loan scheme. These stats are saying that it's estimated that 17 billion of that won't be repaid due to fraud and defaults. That's it's over a third of the bounce back loan money issued is never going to be repaid. And let's not go into the discussion about who's shouldering that. Well, of course, it's the blimmin' taxpayer. It's more about what sort of companies, the companies that are taking bounce back loans when they shouldn't be, because it's either fraudulent. Even the fraudulent stuff, right? And by the way, this article is, I think, about a year old now. 160 million of it was fraudulent already. I mean, it's incredible. Anyway, so the point I'm making here is these could be small businesses, now got into trouble. They've been milking it for a few years, and they're now voluntarily putting themselves into liquidation with potentially HMRC, bounce back loan, maybe some corporation tax in there floating around. I don't know is the answer. I have had a look for some Freedom of Information Act to try and get some figures on this. There's nothing particularly interesting about this. So we've got, well, the only thing I could find is this figure here. So this is really legacy now, right? So if this is legacy, I wonder what it is now. Between 1st of May 2020, 31st of March 2022, 17,000 companies in England that had taken out a bounce back loan facility entered insolvency via compulsory liquidation, creditors voluntary liquidation, or administration. So we can work out the figures there. It's basically 2 years worth. So 8,000. So that's probably like 2,000 a quarter up to 31st of March 2022. But that could easily be more now. That, again, is statistically significant, I believe. So that was another consideration I had. Mix of business size. We just don't know. We just don't know what they are. Now, let's look at the breakdown of businesses, okay? So as I said, the three major business types, it gave us a running graph of the 5 biggest ones that were affected, but just to refresh, construction is the highest, then wholesale and retail trade, then accommodation and food services. So let's have a chat about construction. This is an industry I know a lot about because I've owned a main contractor construction company, and I currently own a scaffolding company, which is obviously in the construction side. Construction is a low profit margin business, right? Right now, so I saw last year we had 3 clients in the scaffold business go bust last year in 2023. Okay, all of them fairly established operators. And the main reason that they put themselves into administration or went into CVL, went into a creditors voluntary liquidation, was the fact they had entered large-scale construction projects. I'm not going to say what the projects are, actually. That's unreasonable for me to say that because you could link it to the companies. Large-scale construction companies pre-COVID, or at least very soon after COVID, before inflation started to really kick off. And for anybody that knows construction, construction can take a very long time. From going out to tender, agreeing contracts, getting on site, building the site out, can be a many-year process. So if you are entering contracts pre-inflation, where you're tying yourself into it, and then you go into it and the costs spiral, so both the cost of materials and the cost of labor start spiraling, because you're on thin margin, very quickly, right, you're in an insolvent position as a main contractor, unless you've got some really good QSs who can fight your way out of it. But the majority, that's where they fall into trouble. So cost spiral, you cannot continue to trade. You are insolvent, and therefore you have to go into administration. Now, what I know happens an awful lot in construction is they will do what's known as something like a pre-pack, or they will phoenix their company. So they'll effectively close that limited company wrapper. And very quickly, they'll either be pre-packing it so they can open again, or create another company, and they just bring everybody else over to the new company, right? And I've never done it myself, but I know a lot of operators all of a sudden are back with the same staff, right, just in a different company. So the reason I'm saying this is, what's the net impact to headcount? Is it the fact these are all going bust and then everybody's out of a job, or because there's such a labour shortage? And yes, it is loosening, but I can tell you right now, construction is still tight. It doesn't just mean you suddenly got hundreds of thousands of people on the street looking for work, right? They're now just going to the different companies. And also with a lot of these companies, a lot of the headcount is self-employed as well. So a lot of self-employed will then be able to go and look for jobs with other contractors for the actual labour. So construction is quite I would say, its own sort of thing. And I think, again, this is important because with all the construction companies going to the wall, are we flooding it with headcount? Some interesting stats. I wanted to look at this with Brexit. Have I got there we go. I did a quick Google as to how many jobs we think we've lost in the UK due to Brexit happening. So, there's some reports. I've not done too much into this. It's just a quick first Google hit. Calculates there are nearly 2 million fewer jobs overall in the UK due to Brexit, with almost 300,000 fewer jobs in the capital alone. So I can tell you in construction, what we've seen is an outflux of skilled labour in the construction space. Brickies, plasterers, scaffolders, right? There are not enough skilled labor to do the work that we need to do, even in what is currently, you know, a slowing housing market, lower new build starts, but there's loads of other work out there. When I talk about the CPI, the monthly CPI print, we look at the construction industry. Construction industry is definitely contracting, but with new build contracting, you then see all of the repairs and maintenance spiking at the moment. So and that's just the residential market. We do huge amounts of work in industrial and commercial clients on massive warehouses, factories, which are falling to bits because they're old Victorian buildings. And we're putting, you know, significant, you know, scaffolding installations into these buildings. So the work is quite insane out there, right? We're not feeling the pinch in our business. We are seeing main contractors, mostly in new build housing, go under, because that is definitely the thing in the subsection of the industry that is struggling a lot. But we've seen a lot of labor go out, and that's not being replaced. The other thing we see in construction is the fact that young kids leaving school, very few of them want to go down apprenticeship routes. And so therefore, again, we're seeing a constriction of supply side of labour, which is forcing up labour costs and just meaning there's not a load of unemployment, right, in that space. And that's anecdotally, by the way. I don't have any facts or figures to back that up. So that's something to think about with construction. Interestingly, I did see this for new build starts. I'm just going to, because we talk about new builds and the new build market going to hell. Bizarrely, right, we had a little spike that in the last data. This is, I think it shows better in the government. I had a look at new build housing starts. We had a surge of new build housing starts at the end of 22, beginning of 23. So that surge was, you know, the highest index of starts we had, like, for decades, right? Like, really unusual spike up. We can see it there. We can see it in the data. And yes, I am aware that it's dropped off. I just want to actually, I just want to go to 1 year and go to, there we go. So actually, this surge, if you can see it here, is in July 23. Now, there must be something that a lot of started, there must be some trigger, and I couldn't think of it off the top of my head, of why all these new build starts started in June or July 23. And then obviously the month after, they dropped off significantly. So it almost seems there's something that they're getting work started. Those will all be in construction. Those will all be in progress right now, these new build starts, right? We're in Jan 24. The majority of these will be ongoing. So it's not like it's completely tied up. And I was quite surprised to see this stat. Now, I don't know if it's erroneous. Who knows? I do not know. So construction, there was a spike in new build starts. However, it does follow logic that a slowing housing market, increased costs, increased labour, lower profit margins due to the fact the property market is not going up, are going to affect new build sites, and probably put main contractors and house builders in difficulty. I think we saw last month or recently Stuart Milne in Scotland go under, big house builder. But logically, so whenever we talk about supply and demand, right, there's one camp that always say the reason UK housing will always go up, and I don't agree with this, by the way, is the supply and demand curve. So if we don't build enough houses, right, the property price is always going to go up. There is some merit in that, right, and there is a tolerance. So of course, there's a supply and demand goes into the equation. I'm still sitting in the camp that the biggest factor, overall macro factor to house prices, is affordability. And the main thing that links into affordability is interest rates. So we'll talk about that at the end when we sum up. But the logic dictates if no new houses are getting built right now, right, it's going to cushion the housing market because it's going to feed into that supply-demand curve. So you can't argue it one way, but not the other way. So there we go. That's housing. And then let's talk about food and hospitality. And I just want to, again, put a concept in front of you. So I think it probably doesn't take a rocket scientist to see food and accommodation, food and hospitality accommodation struggle the most. They're going to be affected by the utility spike, rents, landlords having to put their rents up hugely, cost of labour, cost of food. And I know nothing about the market, but I understand it's probably quite a tight margin economy anywhere. But here's what I want to say. Markets adapt. So yes, we've seen a lot of businesses go under, but to see the whole picture, okay, to understand what's going on, we can't just look at one side of the narrative. I think we have to look at net, how many companies are being created, right? Just overall in the whole economy. So yes, we're seeing these insolvencies, but what's the net amount of company growth? And maybe we can find that in those UK business small stats. But also, when markets are disrupted, let's just track back, team. Let's look at Blockbuster versus Netflix. Okay, Blockbuster gone under, Netflix replaced it. People like Woolworths gone under. Amazon replaced it. We live in a time of rapidly evolving markets, of models, with disruptors out there all the time. And just because one type of industry is being disrupted doesn't mean it's not creating a lot of jobs in a different type of industry. And I think this plays into the argument with things like AI, automation, robotics, so many things that are not just about, it's taking all our jobs. There's other jobs and other opportunities and other spin-offs that come out of all this stuff, right? So let's try and have a look at this. So if we look at, it's gone into trying to charge me something. You look at Uber, right? And this was specifically about Uber Eats, 3.4 billion UK revenue. So I get it. People aren't paying to go to expensive or go to restaurants where restaurants have to charge loads of money to absorb all of those costs, when they can sit there on the mobile phone and order an Uber Eat, right? Or order what's the other one? Deliveroo or a Just Eat or something like that, and have these restaurants deliver, right, to their door. This is actually this is the current and projected growth in the online app-based takeaway ordering transaction numbers between, I think it's 2022 or 2023 and 2028. But we can see a clear there you go. It says at the bottom, 2018 to 2028, a very clear shift in trend, that our habits are changing, and we'll sit at home and order something on Deliveroo and have it delivered to us, right? And of course, that's creating other industries, it's creating other jobs. I know that one of the models that's flourishing right now is commercial kitchens, right? Commercial kitchens in low overhead areas. So let's say an industrial park, an industrial estate, and it's got a big building full of commercial kitchens, right? So it's got none of the overheads of a high street restaurant. It's got none of the overheads of the electrics, the gas, making it look pretty, waiting staff, and that is employment. Waiting staff is employment. I don't disagree with that. But companies or big companies are going and renting these commercial spaces and cooking. Like, let's take, for example, Wagamama's. Why, if everybody's ordering off Uber Eats or Deliveroo, why would you cook that in your high street premise, which is costing you huge amounts in rent and rates, when you can go and rent a commercial kitchen somewhere, okay, and cook it probably for, I don't know, half the price. And then when that Deliveroo comes in, you're going to get your delivery bicycle person, pick it up from your industrial estate and take it to wherever you're going. Much cheaper, much bigger overhead, right? So it's not that things are being destroyed and nothing's replacing it. Industries are evolving and changing and disrupting. So I think that's really important to understand when we look at this data, rather than just go, insolvencies are up, right? The economy is going to be destroyed. I want to see in these stats, just give me a sec, team. I want to see if we've got any stats of the net in 2023, the net amount of companies. So was it a net increase or a net decrease? That's one of the questions that I have. I can't quite see it. Let me just Google it quickly. Net increase in UK companies 2023. See if there's any graphs I can find. Profitability, that's not what we want. I'm pretty sure here we go. Number of private sector businesses. Okay, interesting. Right, so let me just share this screen. Let's put this in. No, it's not giving me the ability to put it into a nice line. So we can see in 2023, okay, we're actually netting out more businesses than in 2022. So 2020, we've seen COVID. I think it's absolutely no surprise that we've seen a big drop off in 2020 or between 2020 and 21, because there's just going to be businesses shutting down. And by the way, we're talking about insolvencies. Insolvencies are where, right, you're insolvent, you're illiquid, you have to put yourself into insolvency. That's different to just dissolving your company. So I'd imagine, okay, there's a lot of people who just went, enough's enough, let's just dissolve the company. And you can do that if you owe nothing to anybody, right? Owe no debt, you can just dissolve the company. You don't have to go through insolvency procedure. So drop down, yeah, and then we've dropped down again into 2022, and we're now on the increase. So there we go. So net increase in 2023. So where does this? Let's tie all this up. Where do I think we are? I'm not saying categorically that the surge in company insolvencies does not mean the economy is in trouble, right? It goes without saying that quantitative tightening is going to put strain on the economy. That's the entire point of it, to try and get rid of inflation. So I'm not saying that at all. I'm saying there's deeper analysis required as to how this is going to feed into the unemployment figures and how that is going to affect the property market. So yes, of course, we've seen some high-profile ones go. What was it, one 10,000? Wilco, wasn't it? Was the highest profile. And you know, I feel for anybody and everybody who loses their job, that is not a good thing. But I'm being objective on this channel and looking at big picture. So there's other things we need to challenge, right, and interrogate to understand what's going on. Where is this going to take us going forward into the rest of this year? Well, we need to keep an eye on unemployment figures, which are pretty much irrelevant right now due to the nature of them and the really low data sets that are coming out. Where do I feel we are going? I just don't feel out on the shop floor in my construction business. I don't feel like it's all self-imploding. I just don't feel it, right? We are working. Our January we just had, we are more profitable this January than we were in last January. We've done less turnover, but we've done it in a more profitable way because we've actually, that's just because I've leaned out the company. In 2024, we're aiming for profit rather than turnover. So we grew a lot last year. Growth causes costs. This year it's about now leveling out, maintaining and focusing on profitability. It doesn't feel like it's imploding, right? We're working with house builders who are building. And you know, a lot of smaller private developers who have different funding streams, you know, have cash funding, are building loads. I've got to be honest. You know, we've got some clients who are churning out really great stuff. I don't think for one moment they're selling them immediately, but they're still building. So it doesn't feel, you know, like it's all imploding. When I go out on the, you know, the rare occasion I go out when I haven't got 5 kids in the house, it doesn't feel like there's nobody out there. It's a ghost town and nobody's spending any money. It just doesn't. And I know this is anecdotal. Where's interest rates going to go? This is the big question because I said at the beginning, interest rates have ticked up a little bit, or mortgage rates have ticked up a little bit. Swap rates ticked up a little bit over January, which was always going to happen. It's never going to continue going down. It has to level out or uptick at some point because they can't just maintain that big discrepancy between swap rates, mortgage rates, and Bank of England base rate. If they've undershot it, it's going to have to come back up again at some point. To get more on parity. We will at some point see interest rates come down. I saw a video, I think it was yesterday, showing a quote from Hugh Pill saying there might be more interest rate rises in the future. Of course there might be, right? If inflation does come back and it hits, right, and wage spiraling continues, or you know the wage curve goes back up, and we have those geopolitical tensions in the Middle East that cause big supply chain issues, of course we might have to see interest rates go up, right? But we're talking about probabilities. We're talking about the range of probabilities. And I've always said there might be one more uptick from 5.25. The probability of that has waned significantly. There is still a possibility, but it's not a massive probability. But of course there's a probability we could go up to 5.5 at some point in the next few months. I think what's more likely to happen is we will flatline for a little bit longer. I think we will start to come down. The big question is, where does it end up, right? What happens with it? I'll go through at some point over the next couple of weeks again the theory behind the long-term real interest rate and its effect on the housing market. And if we stabilize base rate 3.5, you know, the sort of 3.5 to 4% mark or 3 to 4% mark, chances are the housing market won't be going anywhere massively in real terms anywhere soon, right? It'll be stagnating, if not declining, probably for the next 5 years or so. If we go down to sub 2% again with interest rates, the only reason we'll go to sub 2% again is because the economy's fucked. Sorry, excuse my language. So low interest rates means the economy's in a bad place. And I think if we're down at sub 2% with the money machine printing again is to save a self-destructing economy. And without a doubt, we will see temporarily large drops in house prices. That's what I think. Probability wise, I think we'll come down and settle in the threes, somewhere in the threes. For the medium term. When I say medium term, 5-10 years, that's my thoughts. External factors may completely change that. So that's my thoughts. I'd love to see what your thoughts on that are, team. What have we got in terms of thoughts? Let's go through this. Stafford, I saw your point earlier. I'm going to put it on. It's affordability is a perception in time. Inflation slowing makes people think all is well. And I completely agree with you. This is what I've been saying about this affordability thing, that people's affordability, the perception is it's getting better. It doesn't matter that it's much worse than it was 2 years ago. We, as a human species, we do something called habituize, right? Habituize? I can't even say that word. Whatever happens to us in life, we grow accustomed to it. And when we grow accustomed to it, that becomes the new normal. So any transition, anything that happens, any shock that happens, we go through this shock period and then we readjust. And we just readjust our lives. It's like free market economy. We will ultimately live our lives within our means. And if we don't, we will go bankrupt, right? So businesses that don't do it, go bankrupt. People who don't do it, go bankrupt, right? If you're silly with your money, you can blow it all, or you might get lucky and win a load. It's more likely you're going to lose it all. But we habituize, right? So everybody do this. Do an exercise where you just take a white page and just stare at a point on it, right? You will see, if you do it long enough, you'll see the whole white page start to grey out. And that's the brain. Basically, if it's not getting any new inputs into it, it habitualizes and it removes it from your scan. And we do the same with everything. If there's no new inputs, it normalizes. Our brain removes it, and so perception changes. And so much about markets is due to perception. Even if people are getting credit cards and spending it on credit, right, out there buying, anecdotally, I heard a story of one of the kids' friends getting bought like £1,000 coat for Christmas, right? It's like on a credit card. It's like great. But is that a good thing to be doing, or is that just the perception that things are getting better? So you're getting a credit card and putting silly purchases on, which are going to label you down. So perception. I'm not saying it is everybody suddenly got loads of affordability. I'm saying the perception is, and therefore with perception, people go and spend more money, even if it's on debt. I'm not saying it's a good thing in the long run. Right. Stuff saying negative equity, ONS figures so laggy. Yeah, I agree with you. Let's put this on. Retox, good to see you. I think it's first comment I've seen from you with IR35 rules biting. Many are simply wrapping up limited companies. That's a really interesting point. I hadn't even thought about that. That's a brilliant thing. So IR35 is the rules about effectively, how do I phrase this? People working as consultants. So they've got their own limited company working for other companies, and it's the tax treatment of that. Government cracking down to tax them as if they were on payroll. That's a really interesting point, that it could be lots of very small companies wrapping up for that. I think that would be interesting to see those stats. So thank you very much for that. Staff saying unemployment, expect government figures hide a lot. Yes, I also agree with you about that, Stafford. Just to reinforce that fact, when you look at the employment figures, employment classes, anybody in full-time work or anybody in 0 hours contract work. So if you're working 1 hour a month, you're still going to be class employed. Also, everybody who's registered as self-employed will also be classed as employed. Now, interestingly, I wonder if that double counts people. So people who are registered as self-employed and those who are then working on PAYE, I wonder if that double counts them. Interesting thing to put out. But I do agree. I think the figures are hoop. What else we got? Stava, take the COVID cash and run. There we go. Let me know your thoughts, team. Was that thought? Did that raise any thoughts and challenge about that data that we're seeing? And again, I just give me a thumbs up, team, because what I want to do is challenge those narratives that we're seeing everywhere else, and really dig into it and go, it might be the start of the tipping point of everything going horrendously meltdowny, but is it? Are there other explanations, right? And we need to look at all possibilities, regardless of what the probability is, and go, balance of it, that this is the most likely, right? Nigel saying new companies may be landlords converting to limited businesses. That is also valid. I wonder how many make up that. I would say it's probably more likely landlords creating from scratch rather than incorporating. How many? Sorry, I'm typing while live. I'm just seeing if we can find it in 2023. Oh, blimey. Look at that. Oh, that's interesting. Estate agent says 50,000 limited companies were formed in 2023, beating the previous high of 48,520 set the year before. Wow, that's a great little stat, that one. That's significant, I would say, of companies for landlords to do that. So look, I think the point is, there's so many things in this mix that we need to be aware of. So many things. All right, team, look, it's been a pleasure. As always, give me a like if you got something from this video. Please subscribe if you want to hear more about this sort of stuff as we go forward. And I'll see you later in the week after Halifax released their rather tardy January HPI, which I believe is due out this Wednesday. So I'll probably see you Wednesday evening to chat about the Halifax's HPI and see if they've made up some good figures as well. Have a great one. I'll speak to you very soon.